been a bit of a rollercoaster year, an amazing finish to the calendar year last year, thankfully, because of, well, as you quite clearly state here, Q3 was pretty horrendous. And I guess we all knew it would be after that event.
It took a lot of time while people were re-gauging what exactly does it mean. But then as we got into the last 3 to 4 months of the year, I think the market picked up, and I think total volumes last year were about 50 billion.
It's going to be very, very volatile. UK in particular, currency's gone down, so we've got a lot of foreign investment.
What we can say is that the wall of capital overhanging the market is still there. Property remains a very attractive asset class, offering a very good income return with the prospect of asset management and yield compression. We think that the prospect of yield compression has reduced as a result of the impending rise of interest rates. So one is coming up to meet the other coming down.
We're certainly at a point where I think investors have taken stock in terms of where we had got to on certain levels of yield. I think if we were making some general comments, we shouldn't rule out still the appeal of prime.
My view of the property lending market is that it's broadly pretty functional and it's broadly quite healthy. So when we see transactional activity and demand for debt fall, when we see a lot of caution in the equity investing market, inevitably that feeds through to the lending side.
We see volumes increasing from the approximate 50 billion that we saw in 2016. The market is a little bit more confident than it was. The risk premium on property remains attractive over and above the 10-year government gilt, so that's probably a 500 basis point edge.
With a combination of the 20% sterling devaluation and a doubling in the oil price last year, the big question is to what extent inflation is going to permanently move upwards. I think most forecasts are for sort of 2.7% for CPI at the end of this year.
Well, currency is playing a big part, rightly or wrongly. So I think for a long time there's been a growing desire for money to come out of Southeast Asia, particularly Greater China. Statistically, at the large end of the market, they're about 45% of all the buyers.
On the investment side, investors come to us because of our knowledge of the retail occupiers. We're targeting Asian money, where we've seen several of the high-profile investors. They like to know what's going on, and they, to coin an expression, they want to play Monopoly in London.
I don't think volumes will improve dramatically this year, principally because I'm not sure who the sellers will be. It's one of wanting more exposure to the market, but struggling to find opportunities or struggling to find places where we really believe value exists.
There is clear evidence that the institutions are returning to the market. The biggest institutional drivers of the UK capital markets in real estate have been traditionally the retail investor funds. They are experiencing modest inflows.
The trends seem to be very much around industrial and logistics as a sector that is in hot demand.
High spots within the market in terms of resilience. You'd put the alternative sectors right up there with that, and I think also logistics, which has had a strong run.
Include residential, particularly in the southeast, and particularly with an accent on local authority related work.
When everybody else was saying the world's coming to an end, we were getting instructions because local authorities, who vendors perceive to be the outside dog in the race, don't sell to a local authority, cheap source of money, the way they borrow, just ploughed straight on, suddenly became the only horse in the race, and suddenly you're busy acting for local authorities doing their investment schemes.
For 2017, I think we should do better than 2016 because we won't have that Q3 where briefly the world stopped. So I would be surprised if we don't exceed the levels of 2016.